Welcome to the deep dive. Today, we're getting into something really vital in the trading world, risk management.
Absolutely critical stuff.
Yeah, often skipped over, right? So our mission here is simple. Give you, whether you're just market curious or ready to jump in, a real shortcut. We want to unpack the practical steps, the tools that actually protect your capital so you can trade smarter.
Moving beyond guesswork.
Exactly. We've got some great insights pulled from a trading podcast that really digs into this.
Okay, so foundationally, let's talk strategic position sizing. You often hear that guideline, right? Risk maybe 1-2% of your account per trade.
Right, the standard rule. So like if you have a 10,000 euro account, that's what, 100 euro, 200 max risk on any single trade?
Precisely, that's the baseline. But risk logic done right goes deeper. It's about tailoring that risk based on your specific data.
Okay, my data. How do I actually figure that out? What's the method?
Well, you start by backtesting your strategy. Look at the results. Find your longest losing streak. Let's say, for example, it was 8 trades in a row.
Ouch, okay. 8 losses.
It happens. Then you decide your maximum tolerable drawdown for the whole account. Maybe you say, I can handle a 10% dip, but no more.
All right, 10% max drawdown, 8 trade losing streak. Got it.
Now here's the neat part. You divide that max drawdown by the losing streak. So 10% divided by 8.
That's 1.25%.
Right. And just to be safe, to give yourself a cushion, you might round down slightly. Maybe you decide to risk just 1% per trade.
I see. So you're not just plucking a number out of the air. It's directly tied to how your strategy actually performs, warts and all.
Exactly. You're building a personalized defense based on evidence, not just a general rule.
Okay, so that handles individual trades. How does this discipline, connect to keeping the whole account healthy? The bigger picture.
Good question. Looking at the overall account, the goal is really to keep your maximum drawdown. That is, the biggest drop from a peak to a trough in your equity under 25%.
25%, why that number?
Go much beyond that. And it starts hitting hard. Not just your capital, but critically your confidence. It's tough to trade well when you're down significantly.
Yeah, I can imagine.
And, while there are more complex formulas like the Kelly criterion for optimizing bet size, a lot of traders actually prefer something like half Kelly. It's just a bit more conservative, a bit safer.
Gotcha. So position sizing is locked in. What's the next layer? You mentioned stop losses and take profits. Sounds crucial.
Oh, absolutely non-negotiable. You must define your stop loss and your take profit point before you even click the button to enter a trade.
Okay. And how do you set the stop loss? Is it just a random percentage?
No, not random. You should use technical analysis. Things like the ATR average true range, which measures volatility, or maybe key support and resistance levels on the chart, or even moving averages sometimes.
Okay, technically driven stops. And what about the risk to reward ratio? I always hear aim for 2.1 or better. Why is that so important?
It's vital. Think about it. If your winners are at least twice as big as your losers, you don't even need to be right half the time to be profitable overall.
Right, the math works out better long term.
Exactly. And this leads to a key point. Always use automatic stop losses in your platform. Don't just have a level in your head and hope. Hope is not a strategy.
Cut the losers fast.
Cut them fast. Protect that capital. That's the name of the game.
Okay, so individual trades are protected. Now, zooming out again, portfolio level, how do you manage risk across, say, multiple open trades?
Good point. You need an overall risk cap. Generally, try not to have more than, say, 5 or 6% of your total capital at risk across all your open positions combined.
So if one trade is 1% risk, you could have maybe 5 or 6 trades open, max?
Something like that, yeah.
Right.
And diversify. Don't put all your eggs in one basket. Spread risk across different assets, maybe different time frames. Reduces the chance that one market shock hits everything you hold.
Makes sense. This all sounds very disciplined, but, reality bites. What about losing streaks? We mentioned them for calculation, but what do you do when you hit one?
Yeah, that's where adaptive trading comes in. If you hit a rough patch, maybe 5 losing trades in a row, the smart move is to scale back. Reduce your position size.
Like take a breather, risk less until things turn around.
Exactly. It forces you to be more cautious, reassess. And speaking of discipline, a pre-trade checklist is gold. Like a 5-point check before every trade.
Every single one. What's on it?
Yep. Ask yourself, 1, does the setup match my written strategy? 2, is my entry signal confirmed? 3, is my stop loss planned and set? 4, is my take profit defined? And 5, is the risk reward ratio at least 2.1?
5 points every time. Sounds like it could slow you down a bit. Is that really necessary?
It might feel like overhead at first, but honestly, it's non-negotiable for consistency. It stops you from making impulsive emotional mistakes. It becomes second nature pretty quickly.
Fair enough. Discipline muscle. And for continuous improvement. Wow, how do we know if a strategy is actually, working long term?
Data, data, data. Calculate your strategy's expected return. It's basically your win rate times your average win amount,
Yeah.
plus your loss rate times your average loss amount. That gives you an objective measure.
Okay, a mathematical expectation.
Yep. And keep a trading journal. Detailed notes, entries, exits, why you took the trade, how you felt, drawdowns, results. Reviewing this is like mining gold.
The emotional side too, huh?
Absolutely. And update your backtesting regularly, maybe quarterly. Recheck your win rate, your longest losing streak, average loss. Your risk sizing might need adjusting if market conditions change or your performance shifts.
So it's an ongoing process, not just set and forget.
Definitely. And finally, really know yourself. Understand your personal risk tolerance, not just financial, but emotional. How much drawdown can you handle before you start making bad decisions? Maybe you need hedging strategies sometimes. Maybe you just shouldn't trade around major news events if it stresses you out.
Self-awareness is key. Okay, so wrapping up this deep dive, the big takeaway seems crystal clear. It's not really about chasing massive wins, is it?
Not primarily, no. It's fundamentally about how effectively you protect your capital. That disciplined, data-driven risk management, that's what separates the pros from the amateurs in the long run.
It's the long game.
It really is.
So a final thought for you listening. How can you take these ideas, calculated risk, disciplined process, self-awareness, and apply them beyond trading? Think about other areas in your life with uncertainty. What does protecting your capital really mean for you? And that capital might be your time, your energy, or your emotional well-being. Something to chew on.